Hello and welcome to this video on corporate finance, ethical concerns and possible solutions. In this video, we will be discussing the ethical concerns that arise in corporate finance and explore some possible solutions. Corporate finance is a field that deals with the financial decisions made by corporations, such as how to raise capital, allocate resources, and make investment decisions. Corporate finance is a multifaceted field that encompasses a range of financial decisions and activities undertaken by corporations. At its core, corporate finance is concerned with managing the financial resources of a company in order to maximize shareholder value and achieve the company's strategic objectives. One of the primary areas of focus in corporate finance is the process of raising capital. This can involve issuing stocks or bonds to investors, obtaining loans from financial institutions, or engaging in other financing activities. The choice of financing method will depend on a range of factors, including the company's financial position, its growth prospects, and prevailing market conditions. Once capital has been raised, corporate finance professionals are responsible for allocating these funds in a manner that will maximize returns and minimize risks. This can involve making investments in new projects, expanding the company's operations, or pursuing other growth opportunities. Corporate finance professionals must weigh the potential risks and rewards of each investment opportunity, taking into account factors such as market conditions, competitive pressures, and regulatory requirements. Another important aspect of corporate finance is the management of financial risks. This can involve hedging against market fluctuations, managing currency risks, or protecting against losses caused by unexpected events. By managing financial risks effectively, corporations can help to ensure their long-term viability and protect against potential financial downturns. Overall, the field of corporate finance is critical to the success of modern corporations. By making sound financial decisions, managing risks effectively, and balancing the interests of various stakeholders, corporate finance professionals help to ensure that companies are able to achieve their strategic objectives and deliver long-term value to their shareholders. One of the ethical concerns that arises in corporate finance is the issue of conflicts of interest. Conflicts of interest are one of the most significant ethical concerns that arise in corporate finance. They occur when an individual or group has a personal interest that conflicts with the interests of the corporation or its stakeholders, leading to decisions that are made in favor of the individual or group rather than in the best interests of the corporation. There are several types of conflicts of interest that can occur in corporate finance. For example, a conflict of interest can arise when a corporate executive has a personal financial interest in a company that does business with the corporation they work for. In such a situation, the executive may prioritize their own financial interest over the best interests of the corporation and its shareholders. Similarly, conflicts of interest can arise when investment bankers or financial advisors prioritize their relationship with a client over the best interests of investors. For example, an investment banker may recommend an investment opportunity to a client that is not the best fit for the client but benefits the banker financially. In such a situation, the investment banker is prioritizing their own financial interests over those of the client. Conflicts of interest can also arise when corporate executives receive gifts or other benefits from third-party vendors or suppliers that do business with the corporation. Such gifts or benefits can influence the executive's decision-making process and lead to decisions that favor the vendor or supplier rather than the best interests of the corporation. One of the challenges with conflicts of interest is that they can be difficult to detect and manage. It is often difficult to determine whether a decision was made in the best interests of the corporation or in the personal interests of an individual or group. Additionally, conflicts of interest can arise even when individuals are acting in good faith and without intending to harm the corporation or its stakeholders. To mitigate the risks associated with conflicts of interest, corporations can implement several measures. For example, establishing a code of ethics that outlines the expected behavior of employees can help to ensure that all employees are aware of the potential risks associated with conflicts of interest. Additionally, establishing an independent board of directors can help to ensure that decisions are made in the best interests of shareholders and the corporation as a whole, rather than in the personal interests of individual executives. Another approach to mitigating conflicts of interest is to increase transparency in decision-making processes. This can involve disclosing potential conflicts of interest and requiring employees to recuse themselves from decisions where a conflict of interest exists. Additionally, increasing transparency in financial reporting can help to ensure that stakeholders have access to accurate and complete information about the financial health of the corporation, reducing the potential for conflicts of interest to influence decision-making processes. Conflicts of interest are a significant ethical concern in corporate finance. However, by implementing measures such as establishing a code of ethics, establishing an independent board of directors, and increasing transparency in decision-making processes, corporations can help to mitigate these concerns and ensure that decisions are made in the best interests of all stakeholders. Another ethical concern is the issue of financial fraud. Financial fraud is one of the most significant ethical concerns in corporate finance. It occurs when individuals or corporations engage in deceptive practices in order to manipulate financial data or conceal financial losses. Financial fraud can take many forms, including embezzlement, insider trading, falsifying financial statements, and misappropriation of funds. One of the primary reasons why financial fraud is such a significant ethical concern is because it can have devastating consequences for investors and other stakeholders. For example, if a corporation falsifies its financial statements, investors may be misled into investing in the company or continuing to hold its stock. However, when the fraud is eventually exposed, the value of the stock may plummet, resulting in significant losses for investors. Additionally, financial fraud can also have broader negative impacts on the economy as a whole. When financial markets are undermined by fraudulent activities, it can erode public trust and confidence in the financial system. This can lead to decreased investment, reduced economic growth, and increased regulatory oversight, all of which can have significant negative consequences for the broader economy. There are several reasons why financial fraud can occur. In some cases, it may be driven by a desire to meet financial targets or to secure financing for the company. In other cases, it may be motivated by personal gain, such as when individuals engage in insider trading or embezzlement. In order to prevent financial fraud from occurring, it is essential to establish a strong ethical culture within the organization. This can involve developing a code of ethics that outlines the expected behavior of employees, establishing training programs to ensure that all employees are aware of these expectations, and implementing rigorous internal controls to detect and prevent fraud. Additionally, it is essential to increase transparency in financial reporting and to establish regulatory oversight to prevent fraudulent activities from occurring. This can involve increasing disclosure requirements for corporations, implementing auditing standards that are designed to detect fraudulent activities, and increasing penalties for those who engage in financial fraud. Financial fraud is a significant ethical concern in corporate finance. It can have devastating consequences for investors, stakeholders, and the broader economy. However, by establishing a strong ethical culture, increasing transparency in financial reporting, and implementing rigorous regulatory oversight, we can help to prevent financial fraud from occurring and ensure that the financial system operates in a fair and ethical manner. So, what are some possible solutions to these ethical concerns? One solution is to establish a strong ethical culture within the organization. This can involve developing a code of ethics that outlines the expected behavior of employees and establishing training programs to ensure that all employees are aware of these expectations. Additionally, establishing an independent board of directors can help to ensure that decisions are made in the best interests of shareholders and the corporation as a whole. Another solution is to increase transparency in corporate finance. This can involve providing more information to shareholders and the broader public about the financial health of the corporation, as well as increasing disclosure requirements for corporations. This can help to prevent situations where financial fraud occurs by making it easier for investors and regulators to detect fraudulent activities. In conclusion, corporate finance is a field that is fraught with ethical concerns, including conflicts of interest and financial fraud. However, by establishing a strong ethical culture within the organization and increasing transparency in corporate finance, we can help to mitigate these concerns and ensure that decisions are made in the best interests of all stakeholders. Thank you for watching this video on corporate finance, ethical concerns, and possible solutions. Thank you for taking the time to watch this video on corporate finance, ethical concerns, and possible solutions. We hope that it has provided you with a better understanding of the ethical concerns that arise in corporate finance and some possible solutions to address them. It is important for individuals and organizations in this field to prioritize ethical behavior and decision-making in order to build trust and ensure the long-term success of the corporation and its stakeholders. If you have any further questions or comments, please feel free to leave them below. Thank you again for watching.